Hello and welcome to Switzer Investing Insights, brought to you by nabtrade. And today, with reporting season off and running, let's look at some of the top companies that have reported so far. Commbank, CSL, JBHIFI and Telstra. But let's kick off with CSL first, Paul.
Yeah, CSL a half-year profit, Peter. Look, it probably pretty much matched market expectations, almost $1.25 billion. Pretty good result though, up 8% or 11% in constant currency. Sales was strong, particularly with their immunoglobulins, and also some good result with their Seqirus flu business.
Nice pronunciation, Paul.
Yeah, interim dividend, 95 US cents for Australian shareholders. That represents growth of about 18%. Big thing for CSL, Peter, was they upped their profit guidance. So previously for this full year, they've been talking about US $2,050 to $2,110 million. They upped that to a range of $2,110 million to $2,170 million, representing growth of 10 to 13% over FY19. Market like that. Look, this company's done exceptionally well, but it's on its track to becoming Australia's biggest company in market capitalisation. There is nothing in this report to stop it from doing that.
Okay, let's go to Commbank now.
Yeah, look, another good report, and we mentioned earlier on how both CSL and Commbank were so important, I think, for market sentiment. So cash NPAT for Commonwealth Bank of $4,477 million. Look, that was actually down 4.3% on the corresponding half, but pretty much on market expectations. The big news out of the Commonwealth Bank report, I think, Peter, was not that it actually maintained its interim dividend of 200 cents per share, but it basically talked about a gradual return to its target payout ratio of 70 to 80%. Now, for me, what that means is the full year dividend of 431 cents is safe. Yep, barring any unforeseen circumstances. Yeah. So they're going to work really hard to keep paying that dividend, and the return to a more normal payout ratio is going to take some time as they hope to grow revenue and reduce costs.
And that would have helped the share price.
And that's helped the share price. The other big story out of the Commonwealth Bank result was around the capital side. They've got surplus of about $5 billion. That gives them a capital ratio on a pro forma basis when some divestments are completed of about 12.2%, well above APRA's unquestionably strong level of 10.5%. Look, that means we're going to see more capital returns. We're going to get a little one as they neutralise the dividend. There probably is going to be an off-market buyback. Now, it wasn't announced with this result, but I think we're going to see an announcement in the next 6 months or so, Peter, around about $2.5 to $3 billion. They've got about a surplus franking credits of $1.5 billion. So I think that's the market's going to like and still keep talking about that. If you go to some individual highlights of the result, I think the one that the market really liked and probably the most important was the home loan volume growth, Peter. They grew by about 4%, but that's about 1.5 times faster than the whole system. Yeah. Pretty hard for a major bank to grow above system, particularly when you're the market leader, and to do it sustainably. So the market thought that was pretty good. Perhaps a bit of an indictment on perhaps the performance of the other major banks. They also improved their net interest margin, perhaps a little bit of surprise by 1 basis point. A lot of rollouts in digital. They are the leader in digital, and a lot of announcements in terms of that space. The negatives you can't remember is we still have flat revenue growth, so revenue is not inclining and expenses are growing. So negative jaws, Peter. We've talked about positive jaws many times. That's still a challenge for the Commbank, and they're going to have to get better at managing their cost down. They did add some more staff in that period, and they did warn about some net interest margin headwinds. But look, overall, the market really liked the result. It's trading at a huge premium to the other major banks. I think the trade here is not so much to sell CBA, but to sell CBA to buy the other major banks.
Okay, let's go to the country's #1 retailer, JBHIFI.
Yeah, I'm glad you're calling it the #1 retailer, Peter. I've been calling it the #1 retailer for some time, and again, it delivered. It met all the expectations with net profit up almost 9% to close to $175 million. Sales up almost 4% to $4 billion, with improving momentum in the second quarter of the year. An interim dividend up almost 9% to 99 cents for shareholders. JBHIFI Australia, that's the electronics business in Australia that we know about. That's still shooting the lights out, Peter. We're actually starting to see an improved performance from the Good Guys business. That's the furniture and appliances business they bought 2 or 3 years ago. And perhaps for me, the telling point about the JBHIFI result is they keep on getting better each year at reducing what they call their cost of doing business. Now, that's not what they pay for.
Efficiency stuff.
Yeah, that's not what they pay for buying the goods. That's actually about their own costs in terms of salaries and rent and wages and logistics costs and marketing costs. The actual cost of actually selling something, that keeps on coming down, and that impact is starting to flow across to the Good Guys business. Importantly for the market, they raised guidance a little bit for full year sales, and they gave us some NPAT guidance for the full year of $265 to $270 million, representing growth of between 6 and about 8%. So, and a solid start to January.
A nice turn of phrase saying that electronics business is shooting the lights out, Paul. I like that one. Okay, let's go to Telstra.
Look, a bit like the banks, Telstra's in a revenue hole, and that's why income is down 2.8%. And that's, I think, still the biggest challenge Telstra has, is how does it actually grow revenue? Underlying EBITDA down 6.6%. Not great, but excluding the NBN headwind, they actually were able to grow their underlying EBITDA by $90 million. That's the first growth since 2016. That's mainly due to cost cutting and getting a little more efficient at what they're doing. Reported NPAT down 4.6%, but those income, EBITDA and net profit were in line with expectations. A half-year dividend of 8 cents, that was maintained, fully franked. But importantly, remember, there are two components of that. That's the ordinary dividend, which is the 5 cents, that's coming out of their earnings, and the 3 cents, which is coming out of their NBN sort of one-off receipts. Now, those NBN one-off receipts are going to finish at some stage, so there is still a bit of pressure on the dividend. We're probably okay the next period, but I don't think the market's yet to say that Telstra's out of the dividend challenges. It will need to grow its revenue, and that's still the challenge for Telstra. Going to some highlights, there is good momentum with their so-called T22 strategy, and that's around simplification, getting rid of a number of plans, a number of everything they sell, big focus on cost reduction. They are still getting growth in mobiles and NBN. Obviously, the progress in 5G, putting a lot of emphasis around how 5G is going to actually be their next sort of huge revenue opportunity. And they did reconfirm good progress in taking out their fixed costs and ahead to FY22, and they reconfirmed all their guidance for FY20. That's their full year guidance. The negative, as I said, income still declining, so underlying income of about 3.3%. And ARPU, that's their average revenue per user on mobiles, that was down by about 7%. That's been coming in every period because of competition in the mobiles market. They say that's starting to slow down, and that maybe in the second half we may actually get a flattening of ARPU, maybe even a small lift. Look, I can't get excited about Telstra, but look, show me a revenue increase in Telstra and I can start to get excited, but I can't quite see it yet.
Great reporting season at this
Look, it's going okay. I think the most important thing is the two biggies, that's CSL and CBA have reported well. They're the ones that are giving the market a fillip, and I think on the back, that's why the market is up. It's going okay. It's not spectacular, but off to a reasonable start so far.
That's Switzer Investing Insights, brought to you by nabtrade. Thanks for joining us.